Let me ask you something uncomfortable. You studied the macro. You watched the geopolitical signals. You positioned yourself in gold and silver before the chaos erupted. By every logical measure, you did everything right. And yet your portfolio is bleeding, gold down, silver down even harder, over 40 IUE from its peak in some positions. And meanwhile, the headlines that are supposed to send precious metals surging are everywhere. Conflict in the Middle East, central banks hoarding gold at historic rates, a national debt that just crossed numbers that would have seemed fictional a decade ago. So here is the question nobody in financial media is answering cleanly. Why is gold falling in the middle of a crisis it was born to survive? If you don't understand the actual mechanism, not the surface-level explanation but the precise sequence of cause and effect, you will make the wrong call at the single most important moment of this entire cycle. And that mistake could cost you the most significant wealth-building opportunity of the next 5 years. What I'm going to walk you through today is a mechanical sequence, one that is repeated after every major energy shock since the early 1970s, without a single exception. It's not a theory, it's a pattern so structurally consistent that once you recognize it, you'll never be blindsided by it again. By the time we're done, you'll understand exactly why gold drops during a war, the real mechanism, the 50-year historical record of what always follows that drop. A 4-phase recovery pattern that tells you precisely where we are right now, and why the structural setup today makes what's coming larger than anything this market has seen in modern history. Let's get into it. Core content, the mechanism nobody explains clearly. Why gold falls during a war, the actual sequence. Here's the paradox that confuses retail investors every single time. Gold is supposed to be the ultimate safe haven, the financial fortress, the asset you hold when everything else is collapsing. So why, when oil markets get disrupted by geopolitical conflict and inflation fears spike, does gold drop? The answer isn't complicated, but it requires understanding a 6-step chain reaction that the financial press almost never explains in full. Step 1. A geopolitical shock triggers an energy disruption. Conflict in a major oil-producing or transit region sends crude prices surging, sometimes 30, 40, even 50 IRI within weeks. This is the visible, headline-grabbing event. Step 2. The oil spike inflates expectations before it inflates prices. Markets don't wait for CPI data. The moment traders believe inflation is coming, they price it in immediately. Expectations move faster than reality. Step 3. Inflation expectations freeze the Federal Reserve. Any rate cut cycle the Fed had been signaling gets put on indefinite hold. When traders fear inflation is reaccelerating, the central bank cannot ease. Doing so would pour fuel on the fire. Step 4. Frozen Fed policy keeps bond yields elevated. Here's where gold gets hurt. When 10-year Treasury yields sit above 4 EW, a risk-free government bond is paying investors a meaningful return. With zero storage costs, zero volatility, and full liquidity. Step 5. High yields raise the opportunity cost of holding gold. Gold pays nothing. It never has. When a do-nothing asset competes against a 4A yielding bond, institutional capital does the math and some of it rotates out of gold into treasuries. Step 6. Dollar demand surges, mechanically suppressing gold's price. Global investors rushing into dollar-denominated safe havens, particularly U.S. Treasuries, drive the dollar index higher. Since gold is priced in dollars, a stronger dollar means it takes fewer dollars to purchase an ounce. The price falls, 3 simultaneous headwinds, all triggered by the same event that should, by conventional logic, be bullish for gold. That's the mechanism. That's why your portfolio is red while the world burns, and critically, that's why it has always been temporarily red during every major geopolitical energy shock in the past 50 years. The historical record, 50 years of the same pattern. This is not about cherry-picking favorable data points. This is about a pattern so consistent across 5 decades that the burden of proof lies with anyone who argues it won't repeat. The 1973 oil embargo, OPEC cut supply to the United States, crude quadruples in price, gold initially stumbles, then rises over 150 IOE across the following 2 years. And when you extend the lens to the full arc of the 1970s inflationary cycle, Gold's appreciation from 1971 to 1980 was extraordinary by any historical measure. The 1979 Iranian Revolution. Oil production collapses, prices reach levels that seemed impossible just years earlier. Gold initially does very little. Then, over the following 12 months, it surges nearly 90 SA. The next year adds further gains on top of that, the 1990 Gulf War. Iraq invades Kuwait. Oil spikes. Gold pops quickly, then consolidates. Energy and defense sectors lead, but the long-term winner is the investor who held post 9/11. Broad market panic. Gold was under $300 per ounce. Over the following decade, as the global war on terror stretched fiscal policy and the dollar weakened, gold rose over 600 DE, a multi-year run that began in a moment of maximum fear. The 2022 Russia-Ukraine conflict. Gold breaches $2,000 per ounce for the first time. New all-time highs. Institutional validation that the monetary safe haven thesis remained fully intact. The pattern across every single one of these events. Temporary suppression. Structural reassertion. New highs. The mechanism that creates the initial drop. Elevated yields, a stronger dollar, forced institutional rebalancing, is self-limiting. It exhausts itself. And when it reverses, the structural case for gold returns with compounded force. Why 2026 is structurally different from every previous cycle. Here is where the analysis moves beyond historical pattern matching into something genuinely unprecedented. Every previous energy shock and gold cycle occurred within a specific set of structural conditions. Those conditions no longer exist. What exists today is fundamentally more extreme in every relevant dimension. The debt arithmetic. In 1973, total U.S. government debt was a fraction of what it is today. The interest payments alone on current debt levels at prevailing rates represent a fiscal burden that has no modern precedent. This matters because the Federal Reserve's ability to fight inflation by raising rates, the mechanism that resolved the 1970s inflationary cycle, is now constrained by the debt service math. You cannot apply a 1970s-style interest rate response to a 2026-scale debt load without triggering a fiscal crisis that would dwarf the inflation problem you were trying to solve. The Fed is not free to act the way it once was. That changes everything about how this cycle resolves. Central bank buying. In 1973, central banks were net sellers of gold. Today, the world's central banks have been purchasing gold at rates that are double their historical averages, and have been doing so for 3 consecutive years. This is not tactical positioning, this is strategic realignment. When the institutions responsible for managing sovereign reserves are accumulating an asset at this scale, they are communicating something about the long-term trajectory of fiat currency credibility that retail investors should not ignore. The silver supply deficit. 5 consecutive years. The silver market has now experienced 5 consecutive years in which industrial consumption has exceeded mine production. 5 years of inventory drawdown, 5 years of a structural imbalance with no supply-side resolution in sight, because most silver is extracted as a byproduct of mining other metals. You cannot simply decide to produce more silver when the price rises. The production decision belongs to copper and zinc economics, not silver economics. Silver's industrial demand base has no historical comparison. In previous cycles, silver's industrial demand was meaningful but limited. Today, silver is a critical input in solar energy systems, electric vehicles, artificial intelligence infrastructure, defense electronics, and semiconductor manufacturing. These applications share 2 characteristics. They are growing rapidly, and silver's substitution in most of them is either technically impractical or economically prohibitive. The demand base is structurally larger, structurally less price-sensitive, and structurally less replaceable than anything that existed in any previous precious metals cycle. The Fed's constrained toolkit. Paul Volcker could raise rates to 20 NE in the early 1980s because the debt load was manageable enough to absorb that level of monetary tightening. At today's debt levels, a rate environment even a fraction of that severity would generate interest payments that are fiscally catastrophic. The Fed cannot use its most powerful inflation-fighting tool, which means energy-driven inflation embeds more deeply, persists longer, and ultimately demands a monetary response, debasement, that is historically gold's most powerful catalyst. The structural setup in the current environment is more extreme than anything this market has seen in modern history. More debt, more central bank accumulation, more supply deficit, more irreplaceable industrial demand, more fiscal constraint on the policy response. Every previous cycle occurred in a less extreme version of this environment and still produced substantial gold and silver appreciation. What happens when the same pattern plays out in a more extreme structural context? The four-phase recovery pattern. Understanding where we are in this sequence right now is the single most actionable insight in this entire analysis. Phase 1, the panic phase, weeks 1-4. The shock hits, oil spikes. Gold makes an initial move, often dramatically upward, as pure fear buying floods in. Then the mechanical sequence I described takes hold and gold reverses hard. Financial media maximizes anxiety with continuous coverage designed to keep viewers in a state of heightened emotion. Retail investors at this stage typically make one of two expensive errors. They panic sell near the bottom of the initial reversal, or they chase the initial spike and buy near the top. Both decisions are driven by emotion rather than mechanism. What are sophisticated institutional investors doing during Phase 1? Watching, positioning carefully. They have observed this sequence enough times to know that dramatic action in Phase 1 is rarely rewarded. Phase 2, the absorption phase, months 2-3. The initial panic subsides, volatility compresses slightly, gold consolidates or pulls back further from its spike high, silver typically falls harder, 15 to 20 mu or more from peak. This is the phase where the most damaging individual investor decisions occur. Portfolios show red. Headlines begin asking whether gold has failed as a safe haven. The narrative shifts from crisis buying to crisis disappointment, and investors who bought gold for the right reasons as a long-term structural hedge sell it for the wrong reason because it went down in the short term. In every major cycle over the past 50 years, Phase 2 has been close to the bottom. Selling in Phase 2 is how investors convert temporary paper losses into permanent ones and then watch the recovery from the sidelines. Phase 3, the structural bid phase, months 4-18. The panic-driven selling exhausts itself. The structural buyers, central banks accumulating regardless of short-term price, long-term institutional allocators rebalancing toward real assets, and eventually retail investors who become comfortable re-entering, begin establishing positions. Gold finds its footing again. Not the frantic panic bid of Phase 1, the durable structural bid backed by the forces that actually drive long-term precious metals pricing. Miners begin reflecting improved metal prices in their earnings. Energy infrastructure investments appreciate as oil supply disruptions are priced into the medium-term outlook. Most retail investors who sold in Phase 2 are now watching from the sidelines, waiting for a pullback to re-enter. In many historical cycles, the pullback they're waiting for never arrives at a level below their exit price. Phase 4, new all-time highs, month 12 and beyond. This is what the 50-year historical record shows after every major energy shock. The mechanism is consistent. The oil disruption embeds inflation that the Fed cannot fully address without creating a debt crisis. Eventually, the math forces a policy pivot. Rates decline, the dollar weakens, all three mechanical headwinds on gold reverse simultaneously, and gold responds to three simultaneous tailwinds at once. Based on observable price behavior and the timeline of the current crisis, the transition from Phase 2 into Phase 3 appears to be underway. The forced institutional selling that accompanies margin calls and panic liquidations has largely run its course. The structural buyers are active at current levels, silver specifically, why it's a different trade. Most investors treat silver as a cheaper version of gold. That framing misses what makes silver's setup in this cycle uniquely compelling. Silver has a dual nature that no other precious metal shares at the same scale. It is simultaneously a monetary metal and a critical industrial input. This duality creates a characteristic behavior pattern across crisis cycles. Gold typically leads the monetary move. When sovereign risk, currency debasement fears, and safe haven demand drive the initial precious metals rally, gold responds first and most cleanly. Because gold's value is almost entirely monetary, Silver initially lags, then accelerates past gold. The reason, in the early phases of a crisis, the monetary driver dominates and gold outperforms. But as the crisis embeds into the broader economic system, silver's industrial demand adds a second growth engine. And unlike gold's monetary driver, which is largely sentiment-dependent, silver's industrial driver is tied to physical production volumes in sectors that are expanding regardless of macroeconomic conditions. In the 1979 cycle, silver's appreciation from the Iranian Revolution to its peak dramatically outpaced gold's gain over the same period. The industrial base that amplified that move was a fraction of what it is today. The current industrial demand for silver, solar panels, electric vehicles, AI infrastructure, defense systems, is not price-sensitive in the way consumer demand is. A solar project developer, an EV manufacturer, a data center operator does not adjust their silver procurement based on whether silver is at $20 or $40 or $80 per ounce, because silver represents a small fraction of their total project economics. The demand is inelastic, the supply cannot respond quickly, and the monetary bid hasn't even fully arrived yet. When it does, those two forces compound. 1. Identify your current phase before making any move. Ask yourself, is the decision I'm about to make driven by the price I'm seeing today or by the structural mechanism I now understand? Phase 2 is designed psychologically to make selling feel rational. Recognize it. 2. Watch two indicators. Ignore everything else. The US dollar index DXY, when it falls back below approximately 97%, the primary mechanical headwind on gold prices is diminishing. This is your first confirmation signal that Phase 3 is accelerating. The 10-year Treasury yield, when it falls back below 3.5 TPY, the opportunity cost argument against gold weakens to the point where institutional rotation favors precious metals. This is your second confirmation signal. Financial media, daily oil headlines, and geopolitical news cycles will not tell you when the mechanical suppression is ending. The dollar and the yield will. 3. Differentiate your gold and silver allocation intentionally. Gold is the monetary hedge. More stable, less volatile, better suited for capital preservation. Silver is the high-velocity opportunity, more volatile, capable of dramatic outperformance, but requires conviction through the drawdown phases. Size each position according to your actual risk tolerance, not what the bull case makes you want your risk tolerance to be. 4. Think in phases, not in days. Phase 3 and 4 plays historically unfold over 12 to 36 months. Investors who check their gold position daily and react to each move are playing a game that is specifically designed to shake them out before the meaningful appreciation occurs. The ratio trade most investors miss. The gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, expands during Phase 1 and 2 as gold outperforms. It historically compresses dramatically during Phase 3 and 4 as silver catches up and overtakes. Tracking this ratio tells you whether silver's delayed move has begun. When the ratio peaks and begins declining, silver's catch-up phase is in motion. Mining stocks as a leverage instrument. With clear eyes, precious metals mining companies provide operational leverage to the underlying metal price. When gold rises, a well-run miner's profit margin can expand disproportionately because its production costs are largely fixed. This amplifies gains relative to holding the metal directly. It also amplifies losses in the downward phases. Understand this leverage before using it. Physical versus paper. Know what you own. ETF exposure to gold and silver provides price participation but carries counterparty risk, storage trust risk, and, in extreme scenarios, potential for settlement in cash rather than metal. Physical metal ownership eliminates counterparty risk but introduces storage and liquidity considerations. Neither is categorically superior, but every investor in this space should understand specifically what form of exposure they hold and what risks that form carries. The contrarian signal hiding in plain sight. The most reliable entry signal in any Phase 2 is maximum retail pessimism combined with continued institutional accumulation. When financial media declares gold broken and retail investors are selling, while central banks and institutional allocators are quietly buying, that divergence between narrative and structural flow is historically significant. China's silver positioning. A meaningful percentage of global silver refining capacity is concentrated in China, which has categorized silver as a strategically important material and restricted exports. This is not a widely discussed factor in mainstream precious metals analysis, but supply restrictions from the world's largest refiner, layered on top of 5 consecutive deficit years, creates a supply picture that is more constrained than the headline data suggests.